The retail investor has been getting some positive attention as of late. Many Americans have been at home or at their desk far more since the start of the pandemic. Additionally, it's never been easier to get started and place trades as companies like Robinhood have increased ease and access. Many large, popular stocks have done quite well relative to the broad market for an extended period of time. There are a couple of questions that each new investor should ask themselves before placing their first trade, which are: one, is this time different? And two, does it make sense for me to compete against computers and asset managers, both of which are backed by significant resources? In regards to the is this time different, I think about the answer to that question relative to prior periods, such as the late 90s, where stock picking was popular, and also studies like this one by Dalbar, which looks at the average annual returns for investors relative to market averages. While perhaps biased in certain ways, professional investors have been fairly vocal about the likely future failure of this group. Additionally, Robinhood is starting to build a reputation for stories where people are losing significant amounts of money. As investors, to be successful, we need to acknowledge our behavioral biases. There are four primary emotional mistakes that are inherent in us as humans. Number one, overconfidence. There are two components here. First, the perceived quality of our information, and two, our ability to act on this information at the right time. Two, regret. Humans naturally look to avoid this feeling. Allowing this behavioral bias to influence how to buy and sell investments isn't likely to help. Number three, we have a limited attention span. Humans are naturally constrained and will focus their investment attention based on their universe of knowledge. Four, chasing trends. Humans are naturally good at detecting patterns. When they find them, they're prone to act on them. In investing, these patterns are likely already priced into values. Additionally, markets end up being far more random than those involved realize or are willing to admit. The risks of doing it yourself are just as bad as overpaying for investment advice. Investors should focus on what they can control with index-based investing, fee efficiency, and taxes.